Hey everybody, it's Lawrence from Financial Think here. It is Saturday, 7 p.m. in the UK. It's 2 p.m. here in Orlando, Florida. A very balmy 27 degrees Celsius. The air conditioning is hot. Well, no, actually the air conditioning is cold. The weather is hot. The air conditioning is blowing right now, so if you can hear it in the background. But anyway, thank you for joining. Wow, my hair looks a little crazy today. A little bit of an unconventional time here, but needed to do it half an hour early today. I'm actually digging this Saturday live stream, and hopefully you can catch up. If you don't get to watch it live, you can do it on catch up. But thank you for joining. We got a lot to talk about today. We're going to be talking about some peer-to-peer lending stuff. We're going to be looking at a potential new investment opportunity out there that is not strictly peer-to-peer lending, but it's an interesting one. I'm going to give you my 2 cents on that, or my 2p. And we're going to look at Unbolted. Somebody had asked me if I could give my opinions on Unbolted and where we are with them. So we're going to do a quick run through on Unbolted and sort of give you my 2005 update outlook, where I am at with my investment thesis through them. We got a couple of really interesting letter stress email from the email bag that we're going to go through. Some really important stuff too on the emails about really looking at what your investment have been doing for you, and specifically for people that have been invested through financial advisors. So had a bit of a revelation this week, and I always like to just delve into things that are sent to me and really make sure that I know what I'm talking about when it comes to this. Again, not financial advice, but some interesting things. Anyway, quick hi to everybody who is in the stream. If you could hit the thumbs up button, that helps out a ton. And I was going to stick a camera on the official wiener dog of the Financial Think stream, but I don't think it's set up. So, I can't do that. But you can see her down there in the corner for some reason. She has gone off the setup, but she's down there in the corner taking a nap. That's Harley, the official Financial Think wiener dog, hot dog, whatever you want to call it, Dachshund. So thanks for joining. Hi to Colin in the Peak District, Chimpo Naughty in Cambridge, Peter Vince in a very cold and wet Leatherhead, a happy Aki chap. That kind of rhymes, doesn't it? Dave Dawson is here. Really important stuff today. I can't emphasize how important what we're going to talk about today is. So follow through till the end. I know you're going to get a lot out of it. I try to give you some really good value from the stream, and that's what we're going to do today. So, without further ado, let's crack right into it. Dave Ellard, hi, good evening. We're going to take a quick look at LoanPad, what's going on with them. As you know, I decided to up my LoanPad investment a couple of weeks ago, and I check on that dashboard. I want to see what's going on with them. 102.7 million pounds now in total LoanPad loans with a LTV, so total loan to value of 188.9 million, with an important security value of 236 million pounds. Average loan to value still 43%. We have 251 loans now. Average loan size 409,000, and total estimated time to sell and invest less than 1 day. And now I can speak from experience. When I upped my investment allocation into LoanPad, the money did get invested very quickly, less than 1 day, just like they promised. So it's good to see. Still at 19 lending partners, and a total of 318 million pounds has been invested into LoanPad loans since inception, which 595 loans have been paid back. So good stuff. Moving on, we'll do a little bit of news here. Look out, we're behind the paywall, but a quick refresh to sort that out. Capital Rise reports a strong year despite market challenges. Capital Rise has reported a strong financial year. Why do you care? Because I know some of you out there are Capital Rise investors. But they've reported a strong financial year with growth across all areas of the business, having pivoted to bridging financing in the first half of the year amid tough market conditions. The property finance platform reported £105,000 trading profits for the first 12 months to 31st of July 2024, which it defines as core earnings adjusted for non-trading items and impairment against profit recognized in the previous year. If you're an accountant, you probably understand that. It does not disclose its non-adjusted core earnings for the period. Capital Rise saw activity increase from the first quarter of 2024, culminating in record month of July 2024 when the firm originated a record £50 million of new loans. The property market has faced challenges in recent years amidst high interest rates and inflation combined with subdued economic growth. Capital Rise Chief Executive Uma Raja said the platform adapted to challenging conditions for development loans by focusing on providing bridging finance. In the first half of the year, more than 60% of its lending was bridging loans. The firm paid a record £70 million to investors in capital and returns over the course of the year. Capital Rise has secured £290 million of additional institution funding during the period, including a new £250 million facility secured in January 2024. So they now have £300 million of institutional capital to deploy. Interesting story. A couple of things stand out. You look at this number right here. They reported £105,000 trading profit for the first 12 months of July 2004, but it's a pretty convoluted description of what that exactly means. When I first read this, I thought, wow, £105,000 of trading profit for a company like Capital Rise, which is doing, as I believe, primarily London investments. That is a small amount of money, and should that be something to be concerned about? But then, of course, you see this saying it did not disclose its non-adjusted core earnings for the period, so we don't really know what the exact earnings are. Just for transparency, I do not invest through Capital Rise or their loans. Just never really been something that's been on my radar. But this number, I guess, while you could say, yes, it's in profit, which is a good thing, it's not painting a very good financial picture without, again, knowing what this part means of its earnings for non-adjusted core earnings. So it'd be interesting to see. And one has to wonder, why do they not disclose that? It's pretty interesting. Anyway, moving on. UK regulators crack down on financial promotions. This is something that a lot of people in the peer-to-peer lending space were a little upset about, that the FCA said now peer-to-peer lenders could not offer any types of financial promotions to new customers or even existing ones. We used to, of course, all be blessed with things like cashback, which would give us a reason to try out new platforms, and it was a promotion that these peer-to-peer lending companies used to offer to attract new investors. Of course, that disappeared, I would say, in 2023 and 2024. But the FCA's cracking down has also warned influencers about the things that they are promoting on their channels, their social media channels. It says nearly 20,000 financial promotions were withdrawn or amended in 2024 following FCA intervention, and double that amount in 2023. The FCA says that over the past year, we've seen a growing number of misleading and illegal financial promotions. We have stepped up our efforts in response to make sure that financial promotions are clear, fair, and accurate. So it seems like they are trying to stop things like scams happening. They issued 2,240 warnings about unauthorized or potentially scam offers in 2024. Of course, we have all been victims, I think, of scams at some point in our life. On one hand, one could say, well, the FCA is policing this too heavily. But on the other hand, we could say, well, the FCA is trying to protect consumers from getting scammed. Me being obviously involved with the collateral scam fraud that happened, I was an investor through that. definitely have experience with this, so I could see why the FCA wants to step in and really try to protect consumers. But sometimes that can be at the expense of legitimate companies that were actually offering financial cashback promotions. People like LoanPad, Cufflink, companies like that now are unable to do that. Let's keep going. UK property presents great opportunities for fixed income investors in 2025. This was a article, but it's not really an article. It's more like a little advertising piece in the alternative credit investor for Folk to Folk, who we know we've had Roy Warren on the stream before. We should get him to come back on, see how they're doing. But this article basically is saying the UK economy is not in very good shape at the moment, and the equity market is volatile, but the demand factor of property in the UK means that there is more stability in property investing. Folk to Folk allows investors to tap into the inherent value of property without exposing them to the complications of property ownership or the volatility of real estate equity investing, while gaining the benefits of property-backed stability for their capital investment and fixed monthly income. The problem with Folk to Folk for most people is this right here, that you need a minimum of 20 grand for one investment in this company. So to be really diversified and not to have all your eggs in one basket, you obviously going to need to be a high net worth investor with probably 100,000 invested or more, which, let's be honest, for most people that's just not an achievable amount. It says the platform investors can earn fixed returns starting at 8.75% per annum with no fees to invest. Are any of you out there Folk to Folk investors? I'd be really curious. I am not. Again, that's just way out of what I'd be prepared to put into one single loan at the moment. But the things that this article says, some of it I agree with. Some of it, obviously, it's an advertising piece, so it's going to be very pro peer-to-peer lending, pro property investing. I agree that the property market is probably a stable place to put your money, but I also think there could be better places to put money. I mean, even just some of the peer-to-peer lending opportunities out there are decent, and I'm not too worried about the U.S. Stock market and the equity market, even though it is volatile. I think we got some really bullish things happening in 2025. So that was an interesting piece. Again, I was asked about Unbolted recently. I've been investing through Unbolted, I think, since 2018. So, gosh, that is 7 years. 8 years. Is that 8 years? I mean, wow. Time really does fly. I can remember putting in my first deposit into Unbolted in 2018, sort of learning about the business and what it did, and feeling like, it seemed a little bit risky at the time. It was not, it's not a big company, but what I really attracted me to Unbolted was the expertise that they have within their niche, in my opinion. Again, my dad was in the jewelry business, something that I partially understood, and I thought it seems like a decent opportunity for investing. I know rates have changed a little bit from back when I started in 2018, but I do like the fact that they focus on, I would say, primarily luxury pawnbroking with fast-moving assets. They have a good fast-moving assets, and what that means is that their loans tend to be for shorter periods of time. They're not like property loans that could be several years, or even SME business loans. They're loans that could be a period of months, maybe a year. A lot of times the loans get renewed because they're on things like jewelry and gold, and people tend to roll over pawnbroking loans. The good thing about rollover loans is that if you do need access to your money, you could pretty much bet that if you're in some pawnbroking loans, that money is going to be rolled over within a shorter period of time, so you have to wait months. Also, another thing I like about Unbolted is their recovery process. If they have to keep an asset through non-payment, things like a gold ring or a watch, those are very easy to sell at auction. Gold is very easy to value, and a lot of the times There's not really a long drawn out process in the redemption of a asset that is owed money on that they haven't been able to collect from the borrower. So I do like that. What I don't particularly like are things that I don't understand. So things like this right here, leverage or art collection. I have no idea about art. I think art is something that is valued based on just general sentiment of what that art piece is valued at. Again, I don't know anything about art, so it'd be hard for me to be very wanting to invest in things like artwork. But things like gold assets are very easy to value. You can look at what the price of gold is. You can look at how much unbolted loans on a piece of gold and kind of figure out that the loan to value is reasonable, and usually they are. And there's a lot of room to move there, especially with the interest rates being what they are on unbolted. What I also don't like particularly about unbolted is the amount of interest that they pay to their lenders, so to their investors. If you look here on pawn loans, you can see here that their representative APR on a pawnbroker loan is 60%. I mean, that's high. And again, not knocking unbolted in any way for that, because that's pawnbroking loans are expensive. You want access to quick money. You pay a price for that, right? What I think is a little disappointing is that they're paying up to 10.2% per year, so that's 0.85% per month. And you can also do an ISA, by the way, in this company. But typically loans are about 12 months, so there's a huge spread there. I mean, one thing you could say is, okay, at least it's transparent that they're charging an APR of 60% in most cases, and that they're paying their investors 10.2%. So it is transparent, but one would like to see investors maybe that interest rate were to be a little higher. I mean, I think you'd be really happy to get 15, 16, 17, 18% on your investment. That might make this more attractive to more peer-to-peer lenders. So they do have a good track record. They've been obviously operating since 2015. They're good at evaluating the assets that they're lending on. I think in most cases they have had a couple of bumps in the road with some legals that have gone to court, but they tend to be pretty smooth sailing when it comes to that. And they also have an auto lend product, which I really like. You have to use that. If you try to do manual investing, you pretty much won't get anything that goes up on the platform. So auto lend is important. Of course, there is always risk when it comes to any peer-to-peer lending company. It's not FSCS protected, so your investments, it is an investment. You're getting paid 10.2% to take risk. That's what risk, you get paid to take risk. 10.2%, you're not going to get that in a bank. You can go to the bank and get 4. If you want to get 10, you're going to have to do things like invest through unbolted or invest in equities, stocks, and things like that. So it does have some risk involved, and there is a big risk disclaimer down here that says your capital is at risk with no FSCS protection. So they always say when it comes to any type of investing, don't invest unless you're prepared to lose money. It is high risk. How high risk? That is debatable. I don't think it's at the highest risk of lending, but it is definitely a higher risk product, and for that you are getting paid a little bit of a higher interest rate. But generally, I've been pretty happy with Unbolted. It's pretty much a set and forget platform. You put your money in. I haven't really touched anything for a long period of time. I just generally don't. I just check on login occasionally, and that's about it. So I'm happy to continue investing through there, through Unbolted's platform, and we'll see what happens in the future. Again, no guarantees. Moving on. Octopus Energy, one of our readers of the Financial Thing platform sent me this. I did not know this was a thing, but apparently Octopus Energy is now offering a collective investment platform. I wonder if that is actually considered to be peer-to-peer lending, but they They're saying it's a groundbreaking platform with a minimum investment of £25 where you can invest in green energy projects like wind turbines. So you can buy shares in wind turbines. It's the UK's first energy company with an FCA-regulated investment platform aimed at opening up ownership of renewable projects to more people. I went to their website to take a look at this. This is the website. Very cool looking website. I always thought Octopus was cool in the way they marketed and presented things. Of course, if you were a Octopus peer-to-peer lender back in the day, some of you may have been, I was, and it was a very good investment. It didn't pay a lot of interest, but it was stable, and they paid all the money back. They eventually exited that space. I think they were doing property lending back then, but now they've diverted and pivoted to this. Makes a lot of sense because obviously Octopus is an energy company, so in theory what they're able to do is to take money as investments for the things that they're already operating, which is energy and wind turbines. So here you go. This is what they're offering: a no-fee 25 million minimum pound investment. Choose to get any returns you earn paid into your pocket, or you could take it off your Octopus Energy bill. That's interesting. It is FCA regulated. It was not FSCS protected. You can pick a project, invest between £25 and £20,000 in green energy projects, get energized, learn how much your project generates. You can earn dividends as your project sells the energy it generates, or choose to credit them to your Octopus Energy account, or withdraw the dividends if you want to do that. You can see here one of the offerings right here is an Octopus Energy wind turbine. Here in Wales and in Yorkshire, it pays 6% per year. It's an interesting project. I got to be honest though, I was a little bit soured by wind turbines because of our friends over at Assets Capital. I was involved in some of the wind turbine loans that they offered that did not work out well. And when I first saw this, I saw the picture of the wind turbine and I thought, I'm just not really interested in it. But thinking about it more, it's not a terrible investment. I mean, wind turbines operated by Octopus Energy make a lot more sense than wind turbines operated by a third party. Now, the thing is, I don't know if they're all operated by Octopus Energy or owned by Octopus Energy. There isn't a frequently asked question page here, and it's one of the questions was, what due diligence does the collective do? It says, we carry out due diligence on all green energy projects before they list on the collective to assess whether it's reasonable to expect the project to deliver its targeted return. Our due diligence involves analyzing the unlisted company that owns the energy project, including its financial forecast, which is based on energy generation, expected revenue, and costs. It's important to note due diligence does not mean the financial information has been verified, audited, or that target returns are guaranteed. That to me suggests that these wind turbines are not necessarily owned by Octopus Energy. So it's something to keep in mind. How long is a project open for investment? No, that's the wrong one. How long is it open for? Typically about 90 days. You can find the exact closing date in the project share offering document. I would feel a lot better investing into projects that were actually owned by Octopus Energy, so that is not particularly clear. Again, I haven't had a chance to read through all of these FAQs because I just started looking at it today. Will the value of my shares fluctuate? No, so it's like buying a fixed income product. And what I would say too is that 6% worth the risk of investing in something like this. I will say Octopus has been very stable when it comes to what I invested in their peer-to-peer product years ago, but I still think 6% is just so low nowadays. I mean, maybe if interest rates drop down into the 3% range, that 6% will seem okay. 6% is, I think for the risk you're taking on something like this, just 6% isn't really high enough. You got an investment term of 3 years too on these two projects that are being offered here. So for me personally, I would say right now it's a no. Maybe it's something I can try to reach out to them and see if they'd have a representative come onto the stream and sort of explain about this. Is this peer-to-peer? I don't really know if this is considered peer-to-peer lending investment or not. It's something, again, I need to look more into it. But it's definitely an interesting investment. Anytime I see Octopus Energy or Octopus Group, which is a big company involved in an investment, certainly piques my interest. But for now, I think it remains to be seen if this is somewhere where it'd be a good place to put money. All right, let's go to the mailbag. This is a good one. Hello, Lawrence. Just want to say thank you for all the great info you provide. You are welcome. It's hard to know who to trust these days, but I found your YouTube channel really helpful. Glad to hear that. It says, I'm 24 years old. My parents set up a child ISA for me, which is now being turned over to my control. I'm a little confused what to do since a lot of the investments that were made I don't really understand. My parents suggested I continue forward with the financial advisor who set up the account when I was younger, but the returns on the portfolio haven't been very good over a long period of time, 20 plus years. What do you think I should do with this ISA? Thank you in advance, Oliver. It was interesting that I got this email because a family member of mine had asked me sort of the same question recently about what to do with a child ISA. So I think it's really important to, first of all, understand what you're investing in. One thing this email says, which stuck out to me, is I'm a little confused what to do since a lot of the investments that were made I don't really understand. So number one, I don't care how young you are, whether you're 24 or 18 or 50, you should really understand what you're investing in. I think it's highly important. I'm going to show you why. And a lot of people discount, wanting to bother with learning about this stuff and trusting their net worth in the hands of a financial advisor. So let me show you what I discovered on a family member's portfolio that was invested for them actually exactly 20 years ago. And this is through Transact, who is a financial advisor that a lot of people in the UK use. A lot of people, I think my parents were running their portfolio through Transact at one point. So this is the investments that this young person was put into at a very, very young age. Some of it I've never heard of. Some of it I have. Let's take a look. We got the Martin Currie U.S. Constrained Fund. That has had a gain of 130%. Lion Trust European Dynamic 1. Lion Trust U.S. Opportunities Fund. And then here, this is what kind of dismayed me. When I started to read this is when I knew there was a problem. M&G Corporate Bond Class 1. We've got a Schroeder Strategic Bond, a Schroeder Sustainable Bond, Stewart Investors Asia Pacific Leaders Fund, and then Schroeder Recovery Fund down here. So the value here of this account is £27,677. So I did a little back testing on the portfolio. First of all, I was really dismayed to see that a young child's ISA had been invested in a strategic bond. I think bonds have zero place in an investment portfolio for anybody probably younger than 40 years old, and especially a child. Like, bonds don't need to be a part of an investment portfolio for a child for a couple of different reasons. Number one, when you're very young, you have time. If you start investing at 0 years old and you plan to stay invested till you're 50 years old, you have 50 years to ride the wave of whatever the stock market brings. And I can guarantee almost certainly that over a 50-year period, that stock market number at year 50 is going to be considerably higher than it was on year 0. Whereas a bond probably isn't going to achieve very good results. You can see here some of these bonds. This one right here went up 41%. That's 20 years, over 20 years. And this one went up 12.6%. And here the M&G bond went up 14.4%. This is the problem with these financial advisors that are doing very old investment strategies that I just don't think they work anymore. This is the classic financial advisor UK from what I've seen. I saw it with my dad when they invested his money, and I pulled it out of Charles Stanley about 8 years ago. I saw the same kind of thing. I saw different stocks, and I saw a bunch of these funds in there that were high fee funds that were actively managed. There was no passive funds, as you can see on here, not one index tracker. And why? Because these financial advisors don't make money off index trackers. They make money off these actively managed funds, which tend to perform poorly. Even let's say the one that has performed okay is up 130 or 166%, but remember that's over 20 years. So is that great? So I did a little calculating on this portfolio. The total invested was £16,062 and 98p, and the total return, hope you can see this, £27,677 and 27p, which represents a 72.3% return. Again, this is 20 years. And I did a back test on this portfolio. I don't know if you can see this, but basically I put that same starting amount, the £16,062 into a back test portfolio, into a very similar, because this is a US website. It didn't have the UK version of this, but it'd be exactly the same in the UK. Vanguard US equity index tracker. And the result after a 20 year, if they did put that £16,062 in and just left it, the outcome would have been £114,699. So this portfolio has cost this person, what is that, £90,000? So they ended up with 27,677. They could have ended up with 114 to 117,000, probably more with dividends if you include the dividends too, all because some bonehead financial advisor decided that he was going to get paid by putting them into these funds that probably had also upfront fees. They call them load fees at the beginning, so sometimes those can be 5%. So that financial advisor really did this person a injustice by investing them into this compound interest. I was just going to show you this, the 16,062, if it had gone in at 10% annually, by the way, which is what this portfolio would average, generally about 10% over the period of the years. Does it have the yeah, you see the CAGR right here. You probably can't see it, but it's 10.28%. That's what the average of the S&P or the Vanguard US Index Equity Tracker would have done over those 20 years. You can look it up, but the compound interest shows here the investment value would have been £117,710. So this advisor has actually almost cost this person close to 100K in returns. Now, the one thing I will say is that it's really up to ourselves to be proactive and really understand what we are invested in. You can't always put the blame and say, well, it's the financial advisor's fault, because ultimately, at the end of the day, it's really our responsibility to be custodials and of our own money. And this person did not understand what they were doing. They trusted the professional, and I've said this a million times, professionals cannot always be trusted. Yes, there are some decent financial advisors out there. Most of them will not put you in a passive index tracker, but there are a few that will. But this person did not, and essentially cost them a huge amount of money in return. When I ask why this was trusted into the hands of this person, the answer I got was, well, I considered it to be safer. Well, yeah, make of that as you will. lesson learned. If you guys do have a financial advisor out there, please get a printout of what they're investing you in and fix the mess. Because likely, in most cases, what I've seen from financial advisors is they put these... actually, you know what? A lot of the times the financial advisor is not actually even investing the money. They're giving it to a company like Transact and telling them to do it. And this is what they're putting people into. So I don't know if it's the advisor that advised these funds. I can't believe that they would, but it could have happened. But do yourself a favor, and if you do have an advisor working for you, really check and see what they're investing you in, and learn what these funds are and how much they have cost you over the period of a long time being invested in them. Of course, there's going to be outlying examples where an advisor has done well, but if you usually track it against the indexes, the advisor will struggle to keep up because of the fees. So I was really disappointed to see this portfolio and to tell the person about how damaging financially that has been. But you can't look backwards. You got to look forwards. So we're going to fix this portfolio and make sure that all of these funds get sold, and we'll put it in the right place and leave it and sit it for 30 years, and it'll be fine. Another letter from the mailbag. I hope you enjoy these mailbag letters. I do. I like getting them. Lawrence, older stream watcher here. Hope you're doing well. A little bit of advice needed. I've been sitting on quite a bit of cash in the savings accounts waiting for the stock market to drop so I can have a lucky dip. I missed out on the 2022 drop as I thought the markets would fall more, and now I'm having a quagmire on what to do with the money. I must say that I have a very conservative investing strategy which has hurt me throughout the years. Truth is, I get a bit nervous buying stocks and shares. I'm afraid of losing all my money. Money in the savings is quite a significant part of my financial net worth. I only have a small investment pot and a small future pension. Do you have any words of wisdom? Cheers, John and Leatherhead. Thank you for sending that email in, John. I hope you do get to watch this. Yes, savings accounts. I saw a tweet on X recently that is very pertinent to this email question right here. Value of 10,000 US dollars invested 5 years ago. NVIDIA at 285K now. Bitcoin 220K. Tesla 139,000. Facebook 52,000. And then savings account 10,250 US dollars. I think if nothing else, now did we have the insight to put a ton of money into companies like NVIDIA or Tesla at the time? Probably most people don't have that much risk appetite, but what I thought was important was this savings account number down here. You can see how poorly really savings accounts do compared to taking the risk of investing. Now, do I suggest putting all your savings into NVIDIA, Bitcoin, Tesla, and Facebook stock? Probably not. No, what I do suggest doing, again, not financial advice, is just use the index tracker. It's the same thing, but look at how much better off you'd be just investing it into equities and shares than you would just having it eroding away in a savings account getting eaten up by inflation. There's another one right here, another tweet that says value now of 10,000 invested 10 years ago. Now you're at 2.6 million. NVIDIA 123,000 in Tesla, 121,000 Amazon, 108,000 in Microsoft, 107,000 in Netflix, 93,000 in Apple, blah, 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 and it keeps going on. So, obviously index trackers pick these huge companies and have them inside of the index tracker, so you're getting full diversification and exposure. But the last thing you want to do is leave too much money in savings just getting eroded away. Sometimes you have to take risk, obviously depending on how old you are. But I thought there was an interesting comment down here, if I can find it. This shows that investing builds wealth while saving preserves it. A 10K investment today might yield as much in 5 years. There was a person in here that said sometimes you have to take risk. Put a pair of big boy pants on. Here we go, mate. If I had a penny for every time someone stuck with that savings account option, time to wear big boy pants and take some risks. And everybody gets nervous about investing, especially when you're younger. From young people, the most comment I ever hear is, I'm afraid to lose money. I'm afraid to lose what I have. Well, time really overcomes that. As you can see here, from our trusty index, U.S. equity index tracker, look at this. This is what time does for you. You can see the dips. The problem with waiting for dips is you don't quite know when the right time to go is, and sometimes you don't go in because you're waiting for more of a dip. So that's what happened to the person that emailed. They were looking at this 2022 dip right here and never went in, and then end up getting stuck because now they're afraid to invest because the markets, they perceive them to be too high. So don't keep too much money in savings. Keep enough for an emergency fund, and get invested if you have time. Let's go to compare funds. We tried to do this last week. I was really interested. I wanted to come back to this to see how much it costs to hold money into some of these platforms that we get pushed in advertising in the UK. So speaking that we spoke about the ISA and the email asking for advice on that, I wanted to just run through and see how much, if that £16,000 investment had been put into an ISA, how much the fees are on paying for that. So I'm going to put in $16,000, no total monthly savings, so no additional, one fund, and say 3 trades a year. So maybe you add to it 3 times a year. We're going to hold shares, no. Let's run it for 20 years, and then an average rate of return. If we're using our trusty index track, we can go 10%. Let's see who's the cheapest. This is a great tool, by the way. If you're in the UK, it's comparefundplatforms.com. Now, they don't include every single platform. For instance, Vanguard is not on here. And some of the other platforms you may use, like Invest Engine, which I know some people really like because of that. If you do DIY investing, you can do it for free, which I highly recommend. But let's say you wanted to use a different platform. Here's the results. The cheapest being iWeb, Halifax share dealing, where I actually started when I first started investing in my early 40s was through iWeb. And you can see here, you pay about £1,611 in fees over 20 years, which is really not bad at all because every time you make a trade, I think you pay £5 through them. And then it starts to get more expensive. You've got Halifax share dealing, which actually owns iWeb, and you're going to pay close to $4,000 in fees over 20 years. You can see here, look at the net annual cost of iWeb, just 0.05%. I would, again, probably go with something like Invest Engine, just because of their zero fee, but this is about as good as you can get when it comes to low fees. Now, Halifax iWeb's platform honestly sucks. The user interface looks like it was designed in 2000. It's really old, but it gets the job done. You get low fees. They don't put a lot of money into their tech. Costs £5 for a trade. If you're only doing a couple of trades a year to add to your ISA, then it's going to save you money. Then you start to get down to companies like AJ Bell at nearly 0.25%, 0.25%. You're paying $5,000 in fees over 20 years. Charles Stanley, $6,600, and then it gets even more expensive. Fidelity, $6,600. Let's go down to the most expensive here. Chelsea Financial, £11,153 in fees. That's 0.6%. So you can see how expensive even just a low percent fee can be over a long period of time. It doesn't sound like much, right? 0.6%. Look at Hargreaves Lansdowne, another one that I know a lot of people like to use, 0.45%. And there are no caps on these fees, and this is the problem. So $8,473 over 20 years. And then our most expensive interactive investor, I don't know what that is, a super investor account, but 0.79% fees are going to cost you £14,507 over 20 years. So the difference between the most expensive and the cheapest, so you got the most expensive would leave you with a balance of £93,134 versus iWeb, which would leave you with £106,029. So you'd be about £12,500 better off, £13,000 better off, making sure that you try to find that lowest fee platform to hold your ISA for as long as possible. Let's have a look if we just run it for 1 year, see how much those fees are. So then it starts to, let's see, 1 year. You see, I wonder why, is iWeb even on here? Yeah, £131 in fees. So if you're doing iWeb for just a year to hold, that is considered more expensive. And the cheapest, according to this, is Close Brothers at 0.25%. So again, it depends how many purchases you're making and how long you're going to hold it for over a long period of time. But yeah, again, use this form. Again, I would definitely look at Invest Engine to hold a ISA. I think, as far as I know, they have good feedback, and it's just cheap. Here's the costs. Let's look at the costs here of Invest Engine. They have a nice fee breakdown right there. As long as you DIY, you can do it for $0, which is what you want, right? Even compared to Vanguard, you're going to pay $2,500. That's 10 years using your £20,000 ISA allowance. Managed, you're going to pay 0.25% through Invest Engine. But if you know how to do it yourself and you've watched enough of these videos and these streams, you are going to know how to do it yourself. You're going to need to have anybody doing it for you. But those fees can certainly add up. Let's see, moving on. Oh, here's the Trading 212 portfolio update. £29,036.81. So edging up just a little bit this week. And you can see right now we're holding more MicroStrategy, a little bit more Amazon, added to the Amazon position, I think this week. Let's have a look. Maybe I did, maybe I didn't. 3rd of February. Okay, so 3rd of February, a little bit of an added position. MicroStrategy dipped down to 3. You can see here, 2nd of February, we bought 4 shares when it dipped down into the $300 range, and we had that limit. And now we've also added Tesla into the portfolio. Why have I added Tesla? I think Tesla has got a very good long range opportunity for investors. Again, just my opinion, not financial advice. It's interesting, right? I didn't used to be a big Tesla fan. I think their CEO is a little crazy, probably a lot of crazy. But it's kind of obvious to me that when you're so coupled up with a president like the CEO of Tesla is, that he's going to financially benefit from that. We have the release of this cyber taxi, the robo-taxi that's going to happen this year in Austin, Texas in the summer. And for anybody that's never driven a Tesla car, which I did have the pleasure of being in a car with somebody who drove one recently using the full service driving and the autopilot, it's pretty cool. I didn't think I was ever going to be a fan, but the car is pretty cool. Is it the most well-made car in the world? No, absolutely not. Can they become more profitable as time goes on? I think once they add these robo-taxis into the mix, the improvement of the full self-driving, the Optimus robot, they've got a lot of things going on that I think is going to help Tesla as a company continue to grow. I don't know. There's no guarantee with it. It's obviously had a bit of a tough time over the week, so I saw it as an opportunity to take a dip into there. Right now we're down 5%, so that was added. Yeah, we added a little more to the S&P 500 fund, so right now we're sitting at 6,500. Into that, when did I buy? Let's see. We bought 6 shares of that on the 3rd of February. So the goal is to get all this cash deployed during dips in the market and times when it makes sense to go in. NVIDIA had a bit of a rough week, but has bounced back somewhat after being down here. 112 US dollars is now back to 128. So obviously those three stocks here make up a sizable part of this trading 202 portfolio, which hopefully will continue to go into the green so we can give more money to charity. That's why we do it. Oh, and this is another reason why I think the Tesla stock and all stocks in the US and probably in the world are going to do well. So we saw this week an announcement that Trump plans to create a sovereign wealth fund. That is something that other countries in the world have. Norway has one, the Saudis have one. It's basically a way for the US government to invest its assets and its money into things like stocks and different companies. Is it going to be corrupt? Of course. I mean, there's going to be so much money that goes into these funds that is just going to raise the stock market up even higher. And I believe that Tesla will be one of the beneficiaries of all this money. That I don't know where they're going to find this money because, this article also says right at the bottom, where is this money going to come from? And that was one of my biggest questions. It says the U.S. has no shortage of financial firepower. The dollar has held strong as the world's reserve currency. But the U.S. lacks an essential component of any sovereign wealth fund, lots and lots of cash. The Treasury Department is undertaking extraordinary measures to prevent the U.S. from defaulting on more than $26 trillion in debt. The U.S. does not appear to be anywhere close to attaining a budget surplus anytime soon, which means the government must use its cash towards paying debts as they come overdue. Trump has floated funding a sovereign wealth fund with tariffs, and Treasury Secretary Scott Bessent said on Monday the U.S. would monetize the asset side. What are they going to do? Print more money to invest in this fund? I don't think so. But we've been told there's no comparable revenue streams at the federal level that could realistically be used to capitalize a sovereign wealth fund. This whole idea of this $36 trillion in debt that the U.S. does not seem to be able to even take a small piece out of is why I've been, telling you about this Bitcoin strategic reserve, because the U.S., they have no way to get out of this debt. And I think what the president of the U.S. is trying to do is say, well, the only way we're going to get out of it is by taking the assets that we have and investing it. Obviously, all the cash sitting there is devaluating and it's useless because of inflation. Cash becomes worthless. So can we take that cash, invest it, and actually turn that cash into something that will be used to pay down the U.S. debt? So that is why I'm extremely bullish on the markets for 2025. I think if this wealth fund does come into effect, which I believe it will somehow, some way. I don't know how they're going to get the money to invest into it, but this could be billions and billions or hundreds of billions of dollars. It will also mean Bitcoin could be a part of that. Well, of course, what happens when the U.S. government starts buying a bunch of stocks and shares on the market, of course, the markets are going to go up. That's just the way it is. It's going to be very, very bullish. And yeah, so that's good. A little bit of Bitcoin news. Trump Media plans to launch a Bitcoin and Made in America ETF starting this year. So Trump Media and Technology Group said Thursday it has applied for trademarks for a series of ETFs, which are exchange-traded funds, and separately managed accounts with plans to launch them from this year forward. The proposed trademarks for Truth.fi Made in America ETF, Truth.fi Energy Independence ETF, and Truth.fi Bitcoin Plus ETF. Very, very interesting. I'd say that's very, very bullish for Bitcoin. Let's look at the Bitcoin rainbow chart. I really love this chart. It's an interactive chart which kind of shows you the price action on Bitcoin and whether it's generally a good time to buy or not. Usually these red areas at the top are not the best time. And usually the very blue areas at the bottom are the best times. But right now we're sitting kind of in the yellow area right here, which we're getting into this orange. So see, the yellow area is hold. So it's not quite being seen as cheap at the moment. And as we start to get towards this orange area, FOMO intensifies. That means fear of missing out. But we're not even close to those prices at the moment. We're sitting in the 96,000 US dollar range. So this has kind of spooked a lot of people at the moment. There's a lot of sentiment that it's really not bullish on the price at the moment. But things that I read, this is very interesting. Let's see here. I've read a lot of people saying, well, why isn't the price moving? Why isn't the price moving? What's going on? You know, why? This is what I always look back to right here. 1 year ago, the price of Bitcoin was 113% lower than it is today. So sometimes it takes months for these prices to move. Sometimes it happens quickly. Sometimes, as you can see right here, from March 2024 until October, 7 months of just nothing happening. The price just going stuck. And then all of a sudden, price action. November from 67,000 all the way to 98. 1 month. So it's best just to sit on your hands and wait. But I like that. I do like looking at this rainbow. I don't always think it's accurate, but it's an interesting thing to look at. Just if you are interested in Bitcoin and seeing what they suggest is a good time to buy and sell. I think personally not quite right at the moment, but it has been right in the past. So there's no guarantee it's right in the future, but it's an interesting thing to look at. And you can go to coincodex.com/Bitcoin rainbow chart or Google it, and you can see that. And I'm not showing you the screen, so that would be more interesting if I showed you the screen, right? There's the screen with the rainbow on it. See, right now we're sitting here about 95,000. It's saying the bubble territory would be around 128,000, and then serious sell 243,000, with maximum bubble 334,000. So we're way off from that. This is America, how state by state in the U.S. There's a lot of states that are now putting in legislation for a Bitcoin strategic reserve. So a lot of U.S. states have a lot of money they sit on. They don't know what to do with it. So they're proposing in some states for this strategic reserve. Are they going to go through? I don't know. None of them has been approved in the House or Senate of any U.S. states. But you can see here the progress. This little triangle here says in progress, and the red dot is a completed step. So Arizona and Utah have gotten committee approval, so now they're waiting for House and Senate approval, with all these other states, Florida, Illinois, Kentucky, Massachusetts, proceeding forward. And I do believe this list is growing. I think it's now 22 states that are pushing to hold Bitcoin to help their states financially because of the problems that they've been having. So we'll see. I expect a lot of these are going to get voted down in the Senate. Some will be approved. But I think once one gets approved, then there'll sort of be a snowball effect for other states to get the approval for this to happen. Interesting time. Coinbase secures UK approval to expand its cryptocurrency services. Coinbase has secured approval from the FCA to operate as a virtual asset service provider. The milestone allows the crypto exchange to offer both crypto and fiat, so pound services, in one of its largest international markets, reinforcing its presence beyond the USA. With this approval, Coinbase can legally facilitate transactions for retail and institutional clients in the UK. That's kind of a big deal because companies that maybe want to get exposure to Bitcoin but cannot will be able to do so through custodial services of Coinbase. So Coinbase will be able to hold it for them. Interesting. And then finally here, there's a little video that I saw on X. This is the President Trump's crypto czar. His name is David Sachs, who says they're going to evaluate the strategic Bitcoin reserve. So I'm just going to play this for you so you can hear. Hopefully it comes through.
One of the things that the president instructed us to do was to evaluate the idea for a Bitcoin reserve, and so that is one of the things. That's one of the first things we're going to look at as part of the internal working group in the administration. So as soon as we get all that set up, we're still waiting for some cabinet secretaries who are on the working group to get confirmed. So we're still in the very early stages of this, but that's one of the first things we're going to look at is the feasibility of a Bitcoin reserve. I think the concept of the sovereign wealth fund is a little separate, and you'd have to talk to Secretary Lutnick, or soon to be Secretary Lutnick, about that.
Yeah, what I think is going to happen, I think this is being forced down the throat by Donald Trump and probably supported by this guy, David Sachs. I'm imagining some of these older politicians are not particularly happy. They probably don't understand Bitcoin. You could see here this guy on the top right looks very miserable about this announcement, whereas the guy on the left looks happier. We don't know about the guy in the middle because he's being blocked. But generally in politics, it tends to be older politicians who probably don't understand what this even means and why the U.S. government would want to do this. And probably Donald Trump, with his more iron fist ruling, is saying, we need to look into this because we've got to get the U.S. out of debt, and maybe this is one of the ways we do it. It's an interesting piece of news to watch. I think it's going to be a very long and difficult road for the Trump administration to push this agenda through. Some will say it's risky. I don't think it's risky. I think it's actually a very intelligent idea as a way to solve a very difficult problem that this debt hole that the U.S. has got himself into, and other countries too, not just the U.S. If we look at, let's look at the world debt clock and see where we stand right now. You don't think this is going to be a problem, right? I do. I think this debt situation that countries are experiencing right now is a huge problem. Right now, $36.4 trillion of national debt in the U.S. And they're running in deficit, right? So they're only bringing in 29.3 million in GDP a year. 29.3 trillion is coming in, and 36.4 trillion has gone out. Let's look at the UK. 4.1 trillion in national debt, 3.6 trillion in gross domestic product. How is this debt ever going to be paid down? When you have debt, you have to pay interest on the debt. These interest payments are absolutely substantial, right? The U.S. right now is paying, oh goodness, I don't even know what their debt, how much is it? Let's see. Curious to see what their debt payments are. It's on here somewhere. I don't know what it is, but it's crazy. It's literally billions and billions of dollars a year in debt payments. Right here, interest on debt net 1.0, so $1 trillion a year in interest is now being paid on these debts. How is that going to be solved? How's that going to be solved in the U.S.? How's it going to be solved in the U.K.? I don't know. We can look at this is a very interesting website. It's called U.S. Debt Clock, or they have a world debt clock. But you can also go back to, say, the year 1990 and look at this clock. 2.9 trillion in debt back then. And you can see the deficit still, 995 billion coming in, but the debt was 2.9 trillion. So this has been a problem that has been brewing for a really, really, really long time. If we look at 2029, these are projections. It's going to be a 47 trillion in the U.S. With a $2.7 trillion deficit. What a problem. What a problem. How the U.S. is going to fix that, I don't know. And this affects everything. It affects the world, right? It affects the world. It affects the stock markets. It affects everything. So maybe the strategic reserve is the way, or maybe it's the sovereign wealth fund is the way that they start to attack this problem. It's a problem that's not going away. They're obviously doing this Doge project, which is looking at how the government is spending money, fraudulent things that are happening within the government as far as people receiving money, companies receiving money illegally. That's now getting exposed with this U.S. aid investigation that's going on. But I think the damage has already been done, and the strategic reserve may be one of the ways that this damage can be undone. I don't know. We'll see what happens. Anyways, it's interesting. Well, I think we've been going for an hour. Oh yeah, quick announcement. I did reach out to Mike Bristow from Crowd Property, by the way, and he is not going to come on the stream on the 17th, the 27th. He said, let's do it later on in the year. He's going through a transition period, probably doesn't want to talk about what's going on. I understand it. I didn't expect him to come and do it. It's kind of the way it is. So we'll see what happens. We'll see. Maybe I can get the new CEO once he's transitioned over to come on and explain what's going on with the company and see how that's going. So there you go. Well, we've been going an hour, so we'll just take a quick look at the comments. If you haven't hit the thumbs up, I hope you can do that for me. Hit the thumbs up. It just takes a minute or a second, not even a minute. Chimpo Naughty, you want a guest request. David Turner, Chief Executive and Co-Founder of Investment Fund. All right, noted. I will. Where's my pen? I'm gonna put it up here. Invest. I will try to see if I can get them on the stream for you. Mr. Chimpo Naughty. Thanks for the suggestion. Paul Bagworth is here in Kenilworth. Thank you for joining. David Wilson says, I'd rather value a piece of art than Bitcoin. Fair enough. I understand. It's not for everyone. Richard McDougall. Hi, Richard. Great content. Thank you. Crowd Property you could do to tighten up lending and recovery standards. Agree. Hopefully they will. They've got a big bank CEO in place now, so we'll see what he does. The guy apparently has a lot of experience. Suggests a nervous beginner investor could start with a managed portfolio with a low platform and management fee and then move on to DIY portfolios. I like it. Invest Engine looks good. I think Tesla battery storage will be a massive earner. Just shares are expecting a lot at current prices. You know what else I think is going to happen is once they really get this full self-driving down, which I think they will. It might take a while, but I've driven in a car with full self-driving, and it's pretty damn good. I mean, there was like one incident where the car we had to do a U-turn, and the car was trying to do it from the outside lane, which you could see it was going to do it. That wasn't very smart. But I think once they get that full self-driving in full effect, that they're going to license this technology to other electric car companies, and they're just going to make a fortune. Full self-driving, if you want to buy that as an upgrade in the US, it's $8,000 US on top of the car, and you can't transfer it too. If you decide to buy another Tesla, you don't get that $8,000 back. I don't know if there's a discount for another purchase, but people are paying $8,000 for that piece of software. So once it gets licensed to other companies, which I think it will, it's going to be a big revenue maker for Tesla. Yes, you're right. The price cannot be more than 100% lower. That would make it negative. I did say that. Yes, you're right. Yeah, update on Crowd Property Rep will not be here. No Mike Bristow. I think there's a CEO has inherited a messy situation there, so we'll see what happens. I do wish them the best. I think Mike is a good guy and he means well. You know, the company may have just loaned to some problem loans, so we'll see. Hopefully it gets sorted out. Anyway, I got to get out of here. Thanks for joining. Enjoy your weekend. Likely be back next Saturday. I'm liking this Saturday streaming time. I hope you are too. If you can't watch every Saturday, watch on catch up. Please subscribe to the channel. Check out the Patreon if you want to support the channel and myself. Thank you. Appreciate your support. And I will see you next week. That's all I have for you right now. Take care. Bye-bye.